Thank you so much for joining into another episode of your favorite program, The Money Minutes. I know I haven't recorded any messages lately. I've been very busy. Last year, 2020, was a very tough one for everyone, but we came through. And now, like I used to hear from my family, the elephant has passed. We're very close to the tail end of that elephant from passing. So hang in there and take care of yourself and your families. Let's talk about a very interesting question that I keep coming across almost every second day. So, we have clients that own corporations. They have their businesses run under a corporate structure, and they're not sure if they should be taking a salary or they should take out dividends. A lot of people think that, if I take out dividends, it's very good for me because I'm taking profit out of my company. Dividend means profit, and dividends are paid from after tax dollars. As you know, that corporation pays very low, or at least not very low, but low interest or low income tax. And individual taxation can go up to 51%, depending on the province, 53%. Your MTR could be as high as 53%, depending on what province you live in Canada. So, so rule number one, if you're taking out dividends or profit from your company as dividends, remember, there is going to be no RRSP room for you to contribute into. So there is no incentive for you to save money for your retirement within RRSP if you're taking out dividends, okay? Because dividend does not create RRSP room. So that's number one. Number two, you have basically a benefit of not paying any payroll deductions. So because you're not treating yourself as an employee of the corporation, you don't have to pay tax on a monthly or bi-weekly basis to CRA. Okay, we're talking about Canada. And I'm going to use an example for you to really understand what I mean. Okay, you do get a break on tax. So when you get paid dividend income, now remember, your corporation has already paid tax on that dividend because corporation pays you dividends after tax. So now that you've taken that as income, again, it becomes your personal income. So you're going to have to pay tax according to your personal income tax rate. Now what happens, you've paid, let's say you paid 15% in the corporation. Now, if my MTR is another 40%, so really I'm paying 55% tax, which is not right. So with dividends, what happens is you gross up your dividends to the basic amount, which is you're going to get the 25% gross up. So if I take out 40,000, really I'm going to have to show 50,000 in my income, but I get a break of 33% as tax credit. So basically, to give you a discount of the tax that you've already paid in corporation, there is a formula that your accountant will use to write off that extra tax. But really, when you compare apples to apples, there is really hardly any benefit for you to take dividend over salary. However, every individual situation is different. So let's talk about two brothers. Okay, I have a family where one brother runs a corporation, which is a small business, and the other brother is running a corporation, but it's a professional corporation. Professional corporation means somebody who is a professional and they incorporate their license and their business into one corporation. There are different rules to both of these, and we can talk about that in another message. But for today, one brother is running a business and the other brother is running a physician's business under a corporation. So the physician, he has been working with me for many years. So we have everything set up in such a way that, when he receives money from his corporation, he puts taxes away, then he puts his RRSPs away, and he pays tax on a monthly basis. So there is no pile up of taxes at the end. So he's making installments for his taxes. And at the end of the year, he has no worries because his taxes are paid, his RRSPs are contributed, his TFSs are maximized. So this is one scenario. Now let's look at the other brother who became my client a few years back. He is basically taking dividends out of his corporation. He's not showing a salary. He's not contributing into his RRSPs, and he has not contributed into TFSA either. So, both of these guys go and they want to take a loan from the bank. Okay, they want to borrow some funds to buy. One wants to buy a plaza for his office, and the other one wants to buy a building for his business. Now, my physician client gets approved, okay, and the other brother gets declined. And he's wondering why this person gets a preference from these banks over his business. I mean, when you look at it from outside, the professional corporation is earning almost half of what this business is earning. But when they go to borrow, the physician corporation is eligible in no time, but the other business is not. So if you were running a bank, if you were running a loan company to finance other people's business, who would you prefer? Would you prefer somebody who's organized, they have liquidity, they are paying their taxes, they are saving for retirement, they're making use of government schemes and policies, or someone who's dealing with a big business, big cash flow, but completely shows unorganized books? So he's showing dividends, $40,000, $50,000, another $40,000, $50,000 for his wife, no RRSP, pays no installment for taxes. It's regardless of what the dividend or the amount of salary these guys are borrowing. What's important is how organized they are, how clean their books are. To a bank, I've heard over and over again that banks love to loan money to professional corporation, which is true because they have not just one guarantee, they have two guarantees. One guarantee is that they are dealing with a corporation which has a manageable and reliable cash flow. And the other one is these guys have a license online. So before they make any mistake or they run out of business or they put their tools down and say we don't want to work, they have a lot to lose. Okay. On the other side, the business that has no licenses and no government authorities regulating their business in that sense, in the licensing sense, that extra layer of guarantee is not there. This business can, say, no, I don't want to run this business. I want to be in a different business. I want to go back to school. I want to do something else. If that happens, their money is at stake. So I hope this clarifies things a little bit. I don't like going into calculations, but if you want me to, send me a scenario. I will work out the details and I will post it for you. So feel free to send me your questions, your concerns, and we'll take it from there. For now, enjoy yourself, stay safe, and hang in there. Thank you so much.